Hi there, my name is Jason Ayers, Director of Business Development at Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thank you for taking the time to watch our monthly review and commentary for November 2018. Well, October was one of the worst months for equity markets since 2011. Concerns around fading tailwinds from tax cuts, rising interest rates, rising corporate costs, and the potential for tighter profit margins, trade wars, as well as the U.S. midterm election continue to drive investors and money managers to the sidelines during the month in an effort to escape uncertainty. Oil continued to slide while gold moved modestly higher, but remained range-bound despite its history as a safe haven during market sell-offs, perhaps as an indication that things weren't as dire as the quick and violent drop in the equity markets might have suggested. So far, November has offered some relief to investors, with all major stock market indices gaining back some lost ground. The most significant move higher to date has taken place just after the U.S. midterms. Historically speaking, the S&P 500 has posted gains in the 12 months after every midterm election since 1954. So far, stocks are off to a good start, with investors perhaps confident in the belief that history will repeat itself. That said, it is important to remember that there are still several uncertainties overhanging the markets. While our fund performance should benefit in this market environment from our recent repositioning of assets, we have not lost sight of the remaining headwinds. Moving on to fund performance. For the month of October, the equity fund finished down 9.21%, while its benchmark, the TSX Total Return Index, gave up 6.27%. At the end of October year-to-date, the equity fund is down 2.77%, with the TSX Total Return benchmark trailing at minus 5%. Lead manager Alex Brandolini suggests that when the market has a quick change in sentiment, such as it did in October, it creates a damned if you do, damned if you don't scenario. In the past, if an equity portfolio didn't hold U.S. FANG stocks like Google, Amazon, or Facebook, it likely underperformed. During the October sell-off, these same holdings contributed most to the volatility in the equity pool. In addition, rising interest rates have caused a slowdown in housing and housing-related companies. 3 of the equity pool's holdings did experience a pullback due to this factor. Often, it's useful to take cues from other asset classes to get a reading on what may or may not be happening in equity markets. For example, high-yield bonds tend to be very sensitive to macroeconomic factors. With that in mind, the spread or difference between high-yield bonds over corporate bonds has been stable throughout the month. Comparatively, these spreads increased significantly as markets dropped during the corrections of 2008, 2011, and 2015. Spreads being relatively stable through this latest sell-off help us remain positive on equities overall. So what does this mean for the equity fund going forward? While we remain positive on equities overall, any growth in housing-related stocks may take a long time to materialize. As for technology stocks, these business models have a long runway in front of them and still warrant investment. However, given that several investor concerns, including rising interest rates and continuing trade war fears, have yet to be resolved, we'll look to manage risks related to the holdings in this sector with tactical option strategies. Moving on, the income fund finished the month of October down 3.73%, compared to its real-world index income benchmark, which was down 2.25%. Year-to-date, the fund sits positive at 1.39%, compared to its benchmark, which is down 2.21%. During the first week of October, as a result of continued market expectations for Fed monetary tightening, the 30-year U.S. Treasury yield increased to 3.4%. A few days after that increase, equity markets experienced their most recent correction. Historically, aggressive tightening of Fed monetary policy, or simply put, increasing interest rates, has been associated with approximately half of the last 45 recessions, and therein lies the concern for investors. In response, the income fund, which traditionally has an allocation to fixed income in the 33% to 37% range, made a significant shift in asset allocation. Lead manager Mark McAdam confirms that the investment committee made the decision to reduce the exposure to equities and covered call strategies and shifted the weighting to 50% fixed income. During the correction, the protective S&P 500 puts held by the income fund increased in value and the positions were closed. As an additional hedge, the fund was also holding a covered call strategy on a gold mining company. As the market sold off, the position was closed profitably, reducing the overall impact of the market correction on the income pool. After the correction, the same covered call strategy was reestablished with a few adjustments to the options position to help increase the hedging properties. The option writing fund finished October down 7.52%, while its benchmark, the Montreal Exchange Covered Call Writers Index, dropped 2.87%. Year to date, the fund is down 3.55% compared to its benchmark, which still sits positive at 0.62%. Lead manager Richard Croft confirms that the fund's exposure to the FANG stocks, Facebook, Amazon, Apple, Netflix, and Google, contributed significantly to the underperformance during the month. During periods where markets react violently and quickly, we raise cash within the fund and reset the portfolio to take advantage of a recovery. Normally, we see option premiums spike significantly when markets experience this type of sell-off. This provides an opportunity to sell longer-dated options and take advantage of the higher implied volatility, as was the case in February of this month. However, in this instance, premiums did not spike to levels experienced during past sell-offs, which is why we've not significantly extended the term to expiry of current positions, which averaged 38 days at the end of October. On the surface, this low-key response among option traders to the sell-off seems to suggest that market participants believe this is a correction within a continuing bull trend, or perhaps more specifically, a simple rotation out of momentum stocks such as FANG into value stocks. As of the end of October, the option writing fund's overall allocation was 50.74% to value stocks, 17.27% to momentum stocks, and 31.98% to cash. Moving on to our current outlook and expectations. While the equity market correction was intense and difficult, the investment committee's outlook remains consistent with last month's commentary. We are focused on capturing opportunities in the recovery from recent lows and continue to expect slow to modest growth moving forward. However, we have taken a more generally defensive stance in managing the funds, given that periodic and intense market volatility is likely to be more the norm than the exception. Such defensive steps have included increasing the utilization of option strategies to help reduce volatility and manage risk in the funds, increasing exposure to fixed income when and where appropriate, as well as actively harvesting profits and increasing cash holdings to reduce equity exposure and to take advantage of opportunities during the pullbacks.